Oil prices continue to fall, and that does not bode well for some regional banks with high exposure to energy loans. I'm joined by Joe Pucella, Vice President and Senior Credit Officer at Moody's. Really nice to see you once again.
Thanks for having me.
So Moody's recently said it was reviewing the debt of 4 regional banks for possible downgrade. Those banks are BOK Financial, Cullen Bankers, Hancock Holding Company, and Texas Capital Bank shares. You also changed the outlook for 2 banks, Comerica and Amarillo National Bank, to negative. So what's behind those moves? Why were those banks cited by Moody's?
So we took action on those 6 banks in particular because they're the most concentrated to the energy sector in terms of the regional banks. So we rate about 60 regional banks in the U.S., and these are the most concentrated. So their concentration is anywhere between 5 and 20% of their total loans, or 50 to 100% of their total equity.
And obviously the other banks, it's far less.
Right, so for the typical regional bank, less than 2% of their loans are in energy loans, and in terms of equity, about 10 to 15%. So these banks have a significant concentration.
Is the concern that there is a higher default risk?
Right, so the main issue is that we've seen very low oil prices, and we expect that to continue throughout 2016, and that puts pressure on the energy companies, which the banks lend to. So those portfolios are under pressure. We see energy companies defaulting, credit quality slipping, and so as that credit quality deteriorates, that increases probability of default.
But I wonder, too, if it's beyond a default issue with energy loans, does it also spill into the broader economy? So it affects other things like small business lending, mortgages, consumer loans?
Sure, so it certainly can. So as part of the review process on those 4 banks, we are looking at the impact on their other portfolios. These banks tend to operate in markets that are more exposed to oil in terms of growth and employment. And so we can definitely see or potentially see a spillover into other portfolios. The prime example being commercial real estate. In terms of consumer exposure, we have not seen that deterioration yet. In fact, we think that low oil prices are actually supportive of consumer asset quality, and you see that in their consumer portfolios.
Are you seeing it in commercial real estate, though, in terms of problems already?
You're not seeing problems yet outside of some specific markets. You know, Houston is probably the main example where you're starting to see some pressure. In other markets, let's say in Texas, Oklahoma, Louisiana, which are more exposed to energy, you have not seen deterioration in their CRE portfolios yet. But to the extent that prices remain depressed for an extended period, it's likely the first, you'll see that come through.
I'm wondering what options the banks have, because I'm thinking they probably can't sell the loans, so do they have to increase reserves? Is that what you'd want to see?
Yeah, so in fact, you saw that, in 2015, you saw some of that, particularly in the fourth quarter. The banks that you mentioned that we have on review did increase provisions pretty significantly in the fourth quarter, and we expect that to continue in 2016. So that's really the main way to set aside a cushion to withstand higher losses that are likely to happen.
And the 2 banks that are rated outright negative, what is the warnings now that you see for those 2 banks?
So those 2 banks are Comerica and Associated. They have less concentration than the banks we put on review, but still an above average concentration risk. They also don't operate solely in those oil-dependent states. So there's more diversification there. So, we're starting to see some deterioration in those portfolios, and, the negative outlook reflects, the potential for further stress if prices stay low.
We certainly have seen highs and lows in the energy business before, and we've had disruptions in the industry in the past. Are banks better prepared as a group now than perhaps 10, 20 years ago?
Well, I think banks are in a better position today because coming out of the financial crisis, regulators imposed harsher regulations. So banks are better capitalized and they have stronger liquidity than they did in prior years. So that provides a good cushion going forward. But we're kind of in an unprecedented oil market where prices have been lower for longer than in prior decades. And so that's really what's putting pressure on energy companies and will eventually lead to losses for some of the banks.
Joe Pucella, it's so great to talk to you again. Thank you.
Thank you.
I'm Rhonda Schaffler for TheStreet.